Hey there, investors, listen up. Stifel, a well-respected financial firm, is waving a big red flag. This isn't just any ordinary warning, it's a significant heads-up that could impact your financial future. They're predicting the S&P 500 could take a nosedive, losing a quarter of its value in 2025. That's a massive drop, and it could have far-reaching consequences for investors everywhere. That's right, a potential 25% drop. Now, before you panic and sell everything, let's break this down. It's crucial to understand the factors behind such predictions and what they mean for your investments. We've seen this movie before, haven't we? Markets go up, markets go down. It's the circle of life, Wall Street style. History has shown us that the market is cyclical, with periods of growth followed by corrections. But this warning from Stifel, it's got some folks sweating. And you know what? They should be paying attention. Ignoring such signals can lead to unpreparedness and potential financial loss. The market isn't some magical money machine. It's driven by real factors, real companies, real people making decisions, economic indicators, corporate earnings, geopolitical events. All these elements play a role in market movements. And sometimes those decisions lead to bubbles, to overvaluation, to, well, you know the word, crash. When the market becomes overheated, corrections are inevitable, and they can be severe. So, should you be hiding under your bed with all your cash? No way. Knowledge is power, and that's what we're here for. By staying informed and understanding market dynamics, you can make better investment decisions. Let's dive deeper into this prediction and see what's really going on. We'll explore the underlying reasons for Stifel's forecast, examine historical precedents, and discuss strategies to navigate potential market turbulence. Stay tuned, because understanding these insights could be the key to safeguarding your investments and seizing opportunities in the midst of uncertainty. Remember the dot-com bubble? It was a time when the internet was just starting to change the world, and everyone wanted a piece of the action. Companies with little more than a website and a dream were getting millions in funding. Investors were throwing money at anything with a .com at the end of its name, convinced that the internet would make them rich overnight. How about the housing crisis? The early 2000s saw a housing market boom like no other. People were buying homes at skyrocketing prices, often with loans they couldn't afford. Banks were handing out mortgages like candy, and everyone believed that home prices would keep rising forever. It was a time of excess and overconfidence. History has a funny way of repeating itself, especially when it comes to market maintenance. Each time the details might be different, but the underlying patterns are eerily similar. Investors get caught up in the excitement, convinced that this time is different, that the old rules no longer apply. Right now the market is looking a little too familiar. We're seeing unprecedented highs with stocks reaching valuations that seem disconnected from reality. The excitement is palpable and everyone wants in on the action, fearing they'll miss out on the next big thing. We're seeing sky-high valuations, speculative bets, and a whole lot of hype. New technologies and industries are emerging, and investors are pouring money into them, hoping to strike it rich. It's a frenzy, with people making investment decisions based on fear of missing out, rather than sound financial principles. Does this sound familiar? It should. We've seen this kind of behavior before and it rarely ends well. The market's exuberance is often a sign that things are getting out of hand, and a correction might be just around the corner. Think back to the dot-com boom. Silicon Valley was the epicenter of innovation, with new tech companies popping up every day. The promise of the internet was limitless, and everyone wanted to be part of the revolution. But as we know, many of those companies didn't survive the crash. Everyone was throwing money at anything with a .com at the end of its name. It didn't matter if the business model made sense or if the company was profitable. The belief was that the internet would change everything, and that was enough to justify any valuation. Sound familiar? It's like everyone's chasing the next big thing, regardless of whether it makes sense or not. Today it's cryptocurrencies, NFTs, and other digital assets. The excitement is similar, and so is the risk of a bubble bursting. And then there's the housing bubble. The early 2000s saw people buying homes they couldn't afford, driven by the belief that real estate prices would keep rising. Banks were more than willing to lend, often without proper checks, leading to a market that was built on shaky foundations. People were buying houses they couldn't afford, banks were giving out loans like candy, and everyone thought the good times would never end. The belief in ever-rising home prices led to risky financial behavior and ultimately a devastating crash. We all know how that turned out. The housing market collapsed, leading to widespread foreclosures, financial ruin for many, and a global economic crisis. It was a harsh reminder that what goes up must come down. The point is, this market exuberance we're seeing, it's happened before. The details might change, but the underlying psychology remains the same. Investors get caught up in the hype, and rational thinking takes a back seat. And it usually doesn't end well. When the bubble bursts, it leaves a trail of financial destruction in its wake. So as we navigate these turbulent times, it's crucial to remember the lessons of the past and approach the market with caution. So what's making the S&P 500 so shaky? Well, for starters, it's looking pretty pricey. The index has been on a tear, reaching new highs, but this rapid ascent has left many investors feeling uneasy. The higher it climbs, the more people start to wonder if it's standing on solid ground or if it's just a house of cards waiting to tumble. Valuations are high, and some companies are trading at levels that seem, well, a little detached from reality. When you see stocks trading at multiples that are historically unprecedented, it raises eyebrows. Investors are paying a premium, betting on future growth that may or may not materialize. This kind of speculative behavior can be risky. It's like going to a restaurant and ordering a $100 hamburger. Sure, it might be a tasty burger, but is it really worth that much? The same goes for these stocks. They might be good companies, but are they worth the sky-high prices investors are paying? This disconnect between price and value can lead to trouble down the road. On top of that, we've got some potential party poopers lurking in the shadows. Inflation is still a concern, interest rates are on the rise, and the global economy is looking a little fragile. Inflation erodes purchasing power, making everything more expensive, from groceries to gas. Rising interest rates, meanwhile, increase the cost of borrowing, which can slow down economic growth. Any one of these factors could trigger a market correction. And let's not forget about the geopolitical risks out there. Trade wars, political instability, you name it. These external shocks can have a ripple effect, causing investors to panic and sell off their holdings, leading to a sharp decline in stock prices. These things can throw a wrench into the market works faster than you can say sell off. When fear takes over, it can lead to a cascade of selling, driving prices down even further. It's a reminder that while the market can offer great rewards, it also comes with significant risks. Investors need to stay vigilant and be prepared for the unexpected. Okay, so the market might be headed for a bumpy ride. What can you do about it? First things first, don't panic. Now is not the time to make rash decisions. One of the smartest things you can do is make sure you have enough cash on hand to cover your short-term needs. Think of it as your financial safety net. That way, if the market takes a dip, you're not forced to sell your investments at a loss. Another strategy is to diversify your portfolio. Don't put all your eggs in one basket, especially if that basket is looking a little wobbly. Spread your investments across different asset classes like stocks, bonds, and real estate.
Breaking news.
Section 5. The long game, staying invested for future gains. Now I know what you're thinking, Jim. You just told me the market might crash, and now you're saying I should stay invested? Hear me out. While the market can be volatile in the short term, history shows that over the long term, it tends to go up. Think about it this way. When you invest in the stock market, you're investing in companies. And companies innovate, they grow, and they create value over time. That's what drives the market higher in the long run. So, if you're investing for the long haul, like for retirement, don't let short-term market fluctuations scare you off. Stay the course, ride out the storm, and you'll be rewarded in the end. Section 6. Beyond 2025, a future fueled by innovation and growth. Look, I'm not going to sugarcoat it. 2025 could be a rough year for the market. But guess what? The world doesn't end in 2025. In fact, the future beyond 2025 is looking pretty darn exciting. We're on the cusp of incredible technological advancements in fields like artificial intelligence, biotechnology, and renewable energy. These advancements have the potential to revolutionize entire industries and create massive economic growth. And let's not forget about the demographic trends. The global middle class is expanding, and these consumers are hungry for goods and services. That's a recipe for long-term economic growth. Section 7. Don't fear the dip, embrace the opportunity. Here's the thing about market downturns. They create opportunities. When prices fall, it's a chance to buy your favorite stocks at a discount. It's like a Black Friday sale for your portfolio. So if the market does take a tumble in 2025, don't panic. See it as an opportunity to buy low and position yourself for future gains. Remember, fortunes are made in bear markets. Section 8. The importance of financial planning. Be prepared, always. No matter what the market does, one thing remains constant. The importance of financial planning. Having a solid financial plan is like having a roadmap for your money. It helps you reach your financial goals, whether it's buying a house, retiring comfortably, or leaving a legacy for your loved ones. A good financial plan will include things like budgeting, saving, investing, and estate planning. It should be tailored to your individual needs and goals. Section 9. The bottom line. Navigate the market with confidence. So, there you have it. The market might be in for a wild ride in 2025, but that doesn't mean you have to get taken for a ride. By understanding the risks, having a plan, and staying focused on the long term, you can navigate the market with confidence. Remember, knowledge is power, and the more you know about the market, the better equipped you'll be to weather any storm. Stay informed, stay invested, and stay bullish.